Welcome to EnrichMinds.com and to our session on derivatives and options. In our session today, we shall learn what are derivatives and options and how we can use them to either hedge our investments or to make money. In the first part of this session, we shall study derivatives. Let's start with a short video clip explaining what a derivative is, courtesy of Capital.com.
What is a derivative? Derivative is a financial instrument with the price derived from an underlying asset. In a broad sense, it's an agreement between two or more parties. What can be considered an asset? A lot of instruments: stocks, indices, commodities, and even weather. Feel confused? To make things clearer, let's look closer. This is John. He owns a bicycle factory. To produce a new line of bicycles, he will need 5 tons of steel a year from now on. This is Harry. He manufactures steel. He agrees to sell John 5 tons of steel at a certain price on a predetermined date in future. Thus, these two make a contract, or a derivative, with steel as an underlying asset. Okay, but why? Why not simply buy steel when you need it? The answer is simple: to manage risks. Here's what John thinks. What if the price of steel skyrockets and I will lose money? And here's what Harry thinks. What if the price of steel falls and I will lose money? Each of them enters a derivative contract to manage risks, to agree on a price and to protect himself from market fluctuations. Some traders use derivatives to speculate on price moves. In other words, they buy or sell an asset with the expectation of making a profit. There are 5 main types of derivatives: options, futures, forwards, swaps, and contracts for difference. But the goal is always to manage risk or to speculate, or both. Smart traders know that all types of investment come with risks. Derivatives are not an exception. Value of an underlying asset can go against you, resulting in losses.
A derivative is a security whose underlying asset dictates its pricing, risk, and basic term structure. Investors use derivatives to hedge a position, increase leverage, or speculate on an asset's movement. Derivatives can be purchased or sold over the counter or on an exchange. There are many types of derivative contracts, including options, swaps, futures, forward contracts, and CFDs. Some risks associated with derivatives include market risk, liquidity risk, and leverage risk. Derivatives have numerous uses and various levels of risks, but are generally considered a sound way to participate in the financial markets. We shall only discuss options in some detail in this session. Options are a special case of derivatives, so let's now take a deeper dive into the world of options. Let's watch another video on options to better understand what they are.
In order to understand what options are, let's start with an example. Meet Zoe. Zoe has a car. This is Bill. Bill requests from Zoe to give him the right to buy the car from her at $15,000 in cash anytime during the next month. Zoe might agree on the condition that Bill pays her 2% of the value of the car, which is $300, for waiting out the month without a transaction. Zoe cannot sell her car to anyone else during this waiting period. Bill does not have to buy the car in this time frame, but he does have the right to do so. Let's look at the definition. An option is a contract allowing the recipient the right, but not the obligation to transact a known transaction, buy or sell, of a known asset at a known price in a known predefined time frame. A contract, the option agreement between two parties. A recipient of the option right. In our case, it's Bill, also called option buyer or the option holder. A known asset, the core of the option. In our case, it's Bill's opportunity to buy a car from Zoe. at a known price, $15,000, also called strike, and $300, which is the price of the option, in a known predefined time frame, in our case, 1 month. After that time, the option has no value. This predefined time frame in which the option will be exercisable is called the option's term or duration. Options that can be made exercisable at any time during the time period are called American options. Options that can be exercised only at the end of the period are called European. The person giving the right and taking upon himself the obligation, in our case Zoe, is sometimes called the originator or option writer or option seller. The technical name of an option that involves the right to buy an asset at a price is a call option. In our case, Zoe sold a call option to Bill. Options are very useful tools in business and are indeed used to help execute all sorts of transactions and help reach all sorts of business goals. Here are a few examples. A. Sarah is a real estate entrepreneur. She meets Philip, the owner of some land close to the beach, who wants to sell his property. Sarah knows of some friends who would love to buy luxury apartments in this location, which is a high demand zone and characterized by limited supply. Sarah approaches Philip and proposes a deal. The owner will award Sarah with the right, but not the obligation, to buy the land for $3 million anytime within a 24-month period. Within this time, Philip's property is off the market, and Sarah will have time to proceed. Sarah has high conviction in the project and pays Philip $50,000 for the option on the land. Sarah then prepares the plans and finds out she can build 30 condominiums. She approaches 10 friends and offers them to buy a condominium from her at $750,000. 8 agree to the transaction and are willing to commit half the proceeds up front to secure the property. Sarah has sufficient capital to secure the deal and now exercises the option to buy the land. In this case, Philip sold a call option to Sarah. B. Margaret owns a coffee shop chain. One day, a competitor approaches her with a proposal to purchase 50% of her business. Margaret is happy to accept the cash offer and negotiates a $2 million company valuation. For some reason, the buyer doesn't want to buy the whole company, and Margaret worries that differences in business approaches and management styles might pose a problem. Jeff, Margaret's friend, comes up with an idea. The buyer will purchase half the business for $1 million, but will also grant Margaret the right, but not the obligation, to sell her full remaining stake in the business for $1 million. Based on the existing valuation, times 50% remaining stake for a term of 5 years. If Margaret executes the option, the buyer must comply. The buyer awards Margaret the option, and the deal is executed. The competitor buys 50% from Moonbuck's coffee shop. Margaret is $1 million richer. The new partner demands to improve profitability and takes drastic measures such as firing 2 critical high-cost employees. Profits promptly plummet, resulting in an operational loss. Margaret is devastated, but Jeff reminds her of her option to sell the remaining stake in the company, so Margaret promptly exercises the option to sell. The partner finds to his dismay he can't back out from the deal and must shell out an additional $1 million to buy a now worthless, loss-generating business. Margaret had the option to sell her share at a price they agreed to before. This option's technical name is a put option. Think of the option recipient, Margaret in our case, putting the now worthless remaining shares in her partner's hands and taking the money from his pocket. Now Margaret can take her dream vacation and sip margaritas with Jeff.
So, what are options? Options are financial derivatives that give buyers the right, but not the obligation, to buy or sell an underlying asset at an agreed-upon price and date. Call options and put options form the basis for a wide range of option strategies designed for hedging, income, or speculation. Although there are many opportunities to profit with options, investors should carefully weigh the risks. Calls are options to buy, puts are options to sell. There are 2 types of options: A call option gives the holder of the call option the right, but not the obligation, to buy an asset at a predetermined price within a predetermined period of time. The holder will only exercise that right if the underlying asset's actual value has risen or is higher than the exercise price. A put option is the opposite. A put option gives the holder of the put option the right, but not the obligation, to sell an asset at a predetermined price within a predetermined period of time. The holder will only exercise that right if the underlying asset's actual value has fallen or is lower than the exercise price. Here are the main parts of any options position. The underlying security. This is the investment that the option is on. If you buy a call option on Apple's stock, Apple is the underlying. The premium. The upfront cost that the option buyer pays to the seller. The strike price. The price at which you can buy with a call or sell with a put the underlying investment. The expiration. How long you have left to use the option after which it expires. Moneyness. If exercising an option today would earn a profit, it is said to be in the money. Options that would earn a loss are out of the money. How does a call option work? Let's look at an example. Suppose you buy a call option on the stock of a company when the share price is trading at $150. And suppose that the call option you buy gives you the right to buy the stock for $170. Now imagine that the stock price either rises or stays flat. Case number 1. The stock price rises to $200 per share. You exercise your call options, meaning you pay $170 and receive Facebook shares. You can then sell the shares for $200. You earn $200 minus $170, or $30 per share. Case number 2. The stock price stays flat at $150 per share. Your options are not worth anything, so you don't exercise them. You don't buy or sell Facebook shares, and you lose the premium you paid for the options. How does a put option work? The mechanics for put options are similar, except in this case, your options become valuable if the shares fall in price. Let's look at an example. Let's suppose that you already own a certain company's shares, but because you are worried they could fall in price, you decide to buy put options that would let you sell for $140 per share. And imagine that the stock price either falls or stays flat at $150. Case number 1. The stock price falls to $120 per share. You exercise your put options, meaning you sell your Facebook shares and receive $140 per share. By selling for $140 instead of $120, you have reduced your losses by $140 minus $120, or $20 per share. Case number 2. The stock price stays flat at $150 per share. Your options are not worth anything, so you don't exercise them. You hold onto your Facebook shares, but you've lost the premium you paid for the put options. The Black-Scholes model, also known as the Black-Scholes-Merton or BSM model, is one of the most important concepts in modern financial theory. This mathematical equation estimates the theoretical value of derivatives based on other investment instruments, taking into account the impact of time and other risk factors. Developed in 1973, it is still regarded as one of the best ways for pricing an options contract. The mathematics involved in the formula are complicated and can be intimidating. Fortunately, you don't need to know or even understand the math to use Black-Scholes modeling in your own strategies. Options traders have access to a variety of online options calculators, and many of today's trading platforms boast robust options analysis tools, including indicators and spreadsheets that perform the calculations and output the options pricing values. The Black-Scholes call option formula is calculated by multiplying the stock price by the cumulative standard normal probability distribution function. Thereafter, the net present value, or NPV, of the strike price multiplied by the cumulative standard normal distribution is subtracted from the resulting value of the previous calculation. Let's now watch a short video on options.
Options trading is an alternative way for investors to invest in the performance of a security, such as a stock or an ETF. By trading options, an investor attempts to capture the up or down movement of a security while only investing a fraction of the cost it would take to own the actual security. For example, consider a stock that's currently trading at $100. If you purchased a share and the price went up $5, you would have a 5% return. With the right option contract, you could profit from this same jump in the stock price while only paying a small premium that costs significantly less than the price of owning the stock. The ability to make more with less is one of the benefits of options trading. However, the potential for greater profits comes with greater risk of losses. To help you understand why, let's take a closer look at how an option contract works. Unlike a stock, when you buy an option contract, you're not purchasing the security itself. Instead, you're purchasing a contract that gives you the right to buy or sell a security at a certain price before a certain date. Consider this example. Suppose there's a coffee shop chain called Stone Curb Coffee. Stone Curb stock is currently trading at $50 a share. An investor believes that the stock price of Stone Curb will rise. This investor considers taking advantage of this anticipated price movement by buying 100 shares of the stock, but she is concerned about the initial capital requirement. Now, let's assume that there's another investor. He already owns 100 shares of Stone Curb stock and plans to hold on to it for a while. He thinks that the stock price will not increase much over the next few months. Both investors can utilize a call option. This type of option contract gives the buyer the right to buy shares of Stone Curb stock at a set price, called a strike price, at a set time, called expiration. In this case, it's $55 per share in 4 weeks' time. Typically, each standard option contract represents 100 shares, so this one contract would give the buyer the right to buy 100 shares of Stone Curb stock at $55 per share. The buyer purchases the contract by paying the options premium. The premium, or price of the option, is determined by several factors, including the stock price, time until expiration, and implied volatility, which is how much the stock is expected to move during the life of the contract. This premium gets credited to the seller of the call option and helps to partially offset the original purchase price of the stock. For this example, let's assume the total premium is $100. Our buyer pays the $100 and purchases the contract. Now, let's examine what could happen to this investment. Suppose our buyer's instincts were right, and Stone Curb stock is now selling at $60 a share. Remember, the call option gives the buyer the right to purchase shares of this stock for $55 a share. The buyer could exercise the call and purchase 100 shares for $55 each, and then sell them at market value for $60 each, making a profit of $5 per share, not including commissions. Because shares of Stone Curb have risen by $5, the buyer's contract is essentially worth $500. If our buyer sold her contract, she could potentially make around $400 in profit, the value of her contract minus the $100 premium she originally paid for it, as well as any commissions and fees. While the buyer's investment paid off, things didn't work out as well for the seller. Although he was able to collect $100 for selling the option, he missed out on a portion of the stock's appreciation because he was obligated to sell his stock at $55 per share. Now, let's rewind. Suppose the stock moved in the opposite direction and is now selling for $45 a share on the last trading day prior to expiration. The buyer's contract gives her the right to purchase shares of Stone Curb for $55 a share. Because no one would want to pay $55 for a stock that's selling at $45 in the open market, the buyer's contract will likely expire worthless. The buyer is now on track to lose 100% of her initial $100 investment, plus any trading commissions and fees. For the seller, the option expiring worthless is good news. He still owns his shares of stock,
and made $100 selling the option. Although the value of his shares declined, he was able to keep the option premium, less any commissions and fees for selling the option. Keep in mind that this is a simplified example. The pricing of options is very complex, which is why it's important to educate yourself about options and their risks before you invest. While the biggest change comes from the price of the underlying instrument that the contract represents, there are other forces like time decay and implied volatility that influence options prices. While we showed you one example, options can be used in a variety of ways. There are call options, which we just saw, that can be profitable to own if the price of a stock goes up. And then there are put options, which can be profitable to own if the price of a stock goes down. Calls and puts can also be combined in a variety of ways. By buying and selling these options, investors have the potential to make money when the market moves in any direction.
So the main takeaways from today's session are: first, an option is a type of investment that gives the owner the right, but not the obligation, to buy or sell a particular investment at a preset price. A call is an option to buy an underlying investment and makes money when the underlying investment rises in price. A put is an option to sell an underlying investment and makes money when the underlying investment falls in price. Second, they are sophisticated financial instruments with complex math involved and should be considered by sophisticated investors only. But options can be very useful in many situations. Thank you for your time, and until next time then, stay enriched and strong.